I think what happened in August is really important because that was kind of your warning shot. And I think a lot of people just sort of think, oh, that was unfortunate, a couple of weeks. And the reality is we have not made a higher high yet. We're making lower highs. We're sort of trending down in some key areas you've mentioned. So the case is building, and it's like the final straw that breaks the camel's back. You don't know I don't know what it's going to be, but I'm looking at the all of the evidence, and the evidence is continuing to pile up more on the negative side of the ledger than on the positive side of the ledger.
Well, welcome to the On the Tape podcast. Guy Adami, always joined by Danny Moses. Danny, how are you?
Great, Guy. Great to see you.
Typically joined by Dan Nathan, but Dan Nathan is in California. I'm doxing him.
No, on assignment in California.
He's what?
On assignment in California.
Yeah.
Yeah.
We're also joined on assignment. We'll go with that. We're also joined by Mike Wilson, the chief U.S. equity strategist at Morgan Stanley. Mike last joined us on June 28th. It is a thrill to have him back, and it's a perfect time to have him back. But before I even say hello to Mike Wilson, prior to this podcast, you were singing a little John Cougar
Let it rock,
Mellencamp.
let it roll. Let the market bounce, come and
Exactly.
save our soul.
That's where I was going.
Yeah.
Let the market bounce, come and save our
We
soul.
just did that. All right.
Genius. Last time Mike was here, as I mentioned, June 28th, the S&P 500 was 5,500. Today, Mike's back. Today's Wednesday. The S&P is, Danny?
5,500.
5,500.
Let's welcome Mike to the main
Let's
stage.
welcome Mike to the main
Yeah,
stage.
here he
Mike
is.
Wilson, how are you?
I'm doing great, guys. How are
So
you?
the S&P's unchanged, nothing's happened. No, no. A lot has happened since then. So let's go backwards first because I've listened to some stuff you've done, and one of the points you've made, a few of the points you've made is you think the Fed has basically tamed inflation, rearview mirror. You think there's still some hiccups ahead of us. But one of the things you really sort of laser focused on, and I agree with you, I think Danny does as well, is what's been going on with currencies, specifically the yen. I want to start there because the move that we saw on August 5th, I think was sort of basically precipitated by what happened with the Bank of Japan and then the subsequent move in dollar yen. So let's start there and sort of work backwards if that's okay.
Yeah. I mean, a lot has happened. It's the same thing. You look at the index like, well, nothing's happened. I mean, a ton has happened. And I want to go back to early July, actually. That's when we got the first soft CPI number. And that's when the yen bottomed, meaning, 165 was the bottom relative to the dollar. And that was the beginning of this sort of unwind of this idea the Fed was actually probably behind the curve. Okay, inflation was coming down. So we wrote about this at the time. We said, be careful what you wish for. I mean, inflation coming down that quickly is another sign that demand is weak. It's another sign that growth is poor. And look, I mean, the growth surprises have been on the downside now really since April. I mean, it's been a precipitous decline in kind of economic surprises. And now inflation is disappointing on the downside. So let's go back to early July. I think we were on another program. We said there'd be a 10% correction before the election. Lo and behold, it started the next day. We got a 10% correction, whatever. I think we're still in this period, though. We got it quick, but it doesn't mean it's over. I think we're in this period between now and basically the election, which includes another earnings season, another couple payroll reports, and the Fed kicking off its rate cutting cycle. That's a lot of action where the market's going to remain extremely volatile, kind of like today. So back to early July. We start to sell off. The yen starts to basically rally against the dollar, some deleveraging going on there. Then we get what I would call in line to maybe slightly disappointing results from the AI names. Okay, the hyperscalers in particular, people not that happy with the amount of money they're spending and the return on capital is not particularly impressive. So those stocks all kind of rolled over. And that has continued, by the way. Those stocks are now well off their highs. So the AI kind of theme, I think, has lost its luster. Many of our institutional clients have actually divested from that, theme to some degree. Then, of course, we got the events at the end of the month where we had the negative payroll number. Not negative, but disappointing payroll number. And that was really a shot, which then got the carry trade to really unwind. The Nikkei was down 20%, sort of top to bottom in a very short period of time. And then everybody kind of went back to, everything's great. I'm glad that's over. And I'm just not in that camp. I think it's just beginning. And what's beginning is just more acknowledgement that we're closer to the end of the cycle than what perhaps the S&P 500 is saying at 5,500. So what has actually happened is the following. You talked about currency. So currencies, right, the dollar has been weak against most major currencies now for a couple months, and they have not recovered. I mean, the dollar is still kind of at its lows, particularly against the yen. So that has not bounced at all. The other markets, the other macro markets that I focus on, commodities in the tank, okay? I mean, literally in the tank. And then, of course, rates. So now 2-year yields and 10-year yields are probing new lows. 2-year yield spread to Fed funds is as wide as it's been in 40 years, 190 basis points, which is basically the bond market telling the Fed explicitly, you are behind the curve in a big way. Meanwhile, S&P, tried to get back to new highs, didn't quite get there, but we're still closer to highs than the lows. But internally, okay, and this is what we focus on, internally in the stock market, small caps are still nowhere, and defensive stocks now are killing it. So if you look at some of these low beta defensive stocks, I mean, they look like, they're on a flagpole. And that is not a good sign. So in other words, all these markets actually do agree, whether it's currencies, commodities, rates, and the internals of the equity market, all agree that growth is the problem. And it's probably a bigger problem than what the mainstream media is talking about.
So you made the call last time you were on around that time period, the shift from quality growth, quality defensive. And that's exactly what's happened. Correct. On top of a 10% correction that's occurred. I think you agree that the S&P 500 itself, forget about what it's made up of. We know that 7 to 10 stocks carry it, is very expensive relative to all the other things you just mentioned. So we have two choices here. Either we get an acceleration of growth in the economy and things kind of don't, which I don't believe is going to happen because I think once you come off of this growth like this that we've had, it's really hard to turn it around on a dime, right? Or the opposite happens here. And it's self-fulfilling that at some point the S&P will come in and match what's happening in that piece of the puzzle. I know your range is pretty broad, 5,000 to 5,400, because I think we're all done trying to predict the overall S&P when it's so heavy weighted towards a few names. So what are your thoughts here on, if you had to pick a direction, I think I know the answer, and are you still with this quality defensive trade for the rest of the year here?
I don't know about the rest of the year, but for now we are. Now what's interesting is, and we talked about this earlier today and we've written about it, which is when you get these kind of really up moves in the quality defensive areas, the safety names, and rates are going down, what you really got to worry about is when those stocks start going down, because then there's no place else to hide. And that's what we got today, which is the first time we've seen this, which is those low beta defensive stocks actually selling off more than the broader market was when we were at our lows. And that's akin to the yield curve re-steepening. So, we haven't seen the yield curve fully re-steepen yet, but it's in that motion. So, yes, I think the direction of the overall index is probably back towards 5,000. And then that's without a hard landing, by the way. If we get a hard landing, obviously it's going to be much worse. And then, of course, the defensive should continue to perform. But I'm getting a little bit nervous that has had its move now. And maybe the market's going to kind of try to barbell it again with some of the Mag 7, quality growth, and defenses. What I'm comfortable saying is that the low quality stuff, right, the junk, the cyclicals, and the small cap, like that stuff is your underweight.
What's interesting, you bring it up. Utilities is measured through the XLU. If historically, it shouldn't trade the way it's been trading over the last 5 or 6 months. It looks like a technology stock, and that to me is a warning sign. But you said it earlier, and you've said it before. What we're seeing is classic late cycle behavior. Yet you hear people talk about, people that I respect, by the way, to have early to mid cycle based on some of the other things that they're seeing. I don't really fully understand that. I think they're saying that because we've seemingly been in this late cycle for such a long period of time that I guess it feels like maybe we got through it and are starting a new one. Thoughts on that? Because it's a hard nut to crack for me, at least.
It is hard. And I would say, obviously, the COVID cycle has been different in many, many ways. And I think what happened last year, this is the way I will describe it, and people will disagree with this, and some people will agree, which is the reason we avoided a hard landing last year, in my view, is because the heavy-handed of government. The fiscal spending was, out of control, and they found a way to fund it with the latent QE programs of reverse repo, and that's great. They basically, I give them an A+ for extending the cycle. I did. They did a good job. That was their goal. They did a good job. And that has now, I think, fooled people into thinking that, we already had the recession. That was 22. But that's not the case, because in 2022 and 23, when we had those big sell-offs, never once did the defensives lead. Never once did 10-year yields and 2-year yields act the way they're acting now, meaning growth was never the problem in 2022 and 23. It was always about rates and the Fed still being higher for longer, and that was compressing multiples. This is different. This is a very different setup now, and this is classic late. Now we are seeing true classic late cycle behavior. To be honest, I jumped the gun along with a lot of other people. Like, we got the rate call right and 22 right and part of 23 right because of the rate call, and then we probably just jumped the gun a little too far on the ice part of the fire and ice calls. And we've already, we've admitted that. There's a mistake, but that doesn't mean that end game has been, that risk of that end game has been extinguished.
Okay, couple things. You're spot on always, but the best thing that happened to the market last year, ironically, was Silicon Valley Bank. I mean, we can go back and look, but in terms of just, you overlay an S&P 500 chart with the Silicon Valley, and it lines up really nicely for a myriad of reasons. But you said something, and you're right. They extended the cycle, and if that was their goal, you give them an A+. But my question to you is, should that be the goal? Because you're just basically pushing out the inevitable, and the inevitable winds up being worse than it would have been if you allowed nature to sort of run its course. Thoughts on that?
I think there's two ways to think about it. So number one, if you're a policymaker or you're in Washington D.C., you're always going to try to keep people out of a recession. I mean, like it's just not. Your goal is to always avoid the recession if you can, because weird things happen in a recession. Now, interestingly, Neil Kashkari said this a while ago, and I thought it was pretty interesting. He said, "Look, I'm going around the country and I'm getting feedback from people. Inflation is still killing people, and yeah, inflation rates are down, but the price levels are brutal." And when you really think about it, a recession is way better for the average person than inflation. So it's a really good question for policymakers to think about. Like, should we just take the recession? Yes, it's terrible for the 5% who get fired, but we have programs for them that can help them, right? Get them back on their feet. We can do unemployment insurance. But you're punishing the other 95% by allowing inflation and levels of prices to stay elevated. So it's a really interesting policy question, Guy. I don't know that you're ever going to get people to agree on that, but I think there's obviously motivation to keep us out of recession. But if you're really looking out for the citizens, I would argue recessions are actually not a bad thing.
100%. And I'm sorry, Danny, real quick, I agree with you. And if you think about it, they'll look back. Historians will always look back in time. But if what they were doing was successful in terms of keeping us out and extending the cycle, then the president's approval rating when it came to the economy would be at close to historic highs instead of historic lows, especially against the backdrop of a stock market that's at historic highs. So what have they done? I mean, people feel like it's not great, yet they're trying to make it great, understanding that the inevitability of the recession is just around the corner. I don't know if that sort of setup makes sense, but again, in trying to prolong the inevitable, people are suffering now, and I think they're going to suffer more on the back end of this entire thing.
We don't know if it's going to be better or worse outcome in the end, okay? But, I think that these things explain sort of how most people's models got it wrong last year, ours included, in terms of like the magnitude of the earnings recession. We got the earnings recession correct, but it just wasn't as deep as we thought it would be, and the negative shock of the rate hikes in terms of what that did to the overall economy. So we're just always looking for reasons for why things didn't play out the way we think. And then that way we can get the next thing right. So now what I'm focused on is all of this stuff has happened. I'm still very laser focused on the data releases, particularly labor. And I think that's the thing that's really hard to argue now. The labor market is absolutely weaker than anybody thought it would be 6 months ago, if you look at the data clearly. And not a recession yet, but the trend is wrong. So if that's the case, then you have to be sort of risked off a bit in the structure of your portfolio. Bonds have done really well, okay? Defensive stocks have done really well, and that has worked. And, whenever you say things like, we recommend things like that to people, they get all depressed because you're like, well, why are you telling me to go into because that's what you're supposed to be doing. I mean, I'm not here to depress you. I'm here to protect you or have you make money. So I think that's what I'm trying to do, is just not get too laser focused on, is this the right policy or the wrong policy? But
fair enough.
What's going to happen next?
No, fair enough.
So it's the stock market is not the economy and vice versa. That's really what you're saying. The stuff that I'm seeing, I forget the government data, the auto delinquency stuff that's rearing its head. It's been ticking up for some time, but all of a sudden people paid attention to it yesterday. We know where credit card debt is. We know that the lower income consumer is starting to get hit here. That is a late cycle normal thing that's going to occur. In 2006 and 7, and I'll never compare anything to the global financial crisis, a great financial crisis, whatever people want to call it, because people were ignoring a lot of the stuff. And I think a lot of the reason they ignore the stuff, and I've said this all the time, is just human nature. A lot of the portfolio managers and people that control money don't deal with those issues. They're in New York and Boston. They don't see this stuff happening. It's not happening to them until it's right in front of their face. They're forced to make a decision. So here we are, and I think you would agree, these things don't just bounce back, as I said on the first question I had. They don't turn around on a dime. They're in motion into a cycle. So what is the tipping point at some point that convinces people, not on the government data, not the jobs data, but on an earnings recession data, or earnings start to drop precipitously, that whether it's banks that need to be reserved, whether it's used car prices that continue to drop, what are you looking at to really signal that, or show people that?
Yeah, I mean, well, it's been happening, right? These are sort of stock by stock, sector by sector. I mean, like, you have companies that report bad results and they get walloped. So that means it's not in the stock. I mean, I've seen a bunch of those in the last 2, 3, 4 weeks, many in the consumer space or financial.
Dollar General, Dollar Tree,
exactly.
all these things.
Same. So that tells me that the market's not priced for that news yet. Now, what usually happens is you get some event, okay, like an SVB or a Lehman Brothers going bankrupt, or 9/11, or COVID, where it's like it's just so insurmountable, the market goes there. Typically, though, the market will start to sniff it all out, and it's usually about a month or two ahead of whatever that event is. So I think what happened in August is really important, because that was kind of your warning shot. And I think a lot of people have just sort of think, oh, that was unfortunate, a couple of weeks. And the reality is we have not made a higher high yet. We're making lower highs. We're sort of trending down in some key areas you've mentioned. So the case is building. And it's like the needle, it's like the final straw that breaks the camel's back. You don't know I don't know what it's going to be, but I'm looking at the kind of the all of the evidence. And the evidence is continuing to pile up more on the negative side of the ledger than on the positive side of the ledger.
To your point, this has been much more of a stock picker's market. It has been now for several quarters, and the passive investing dominance has never been this dominant going into a potential slowdown or a cycle that we're saying. So therein lies the opportunity. Your job is to not pick individual stocks. Your job is to pick the sectors and where to overweight, underweight there. But what do you tell people who take comfort in owning an ETF? Certainly it can be okay. When you have winners and losers potentially in every single aspect of it, what are the screens that people should be looking at or running? I get the Russell. You want rates to come down because there's a company that are high in debt, cost of finance is higher. But what do you do in that case in terms of
the most important variable right now is quality. That's a late cycle environment, and only like you bounce between quality growth and quality defensive.
When you say quality, just to be clear,
good balance sheet,
good balance sheets,
return
right.
on capital,
Yep.
right? They have decent margins, some pricing power. So these are the variables that typically line up. And, you can look on Google or whatever and get a screen of like what goes into those things. And then you can screen on some platforms, you can screen for an ETF. It'll tell you, is this a high quality, low quality sort of ETF? I wouldn't like flip over your entire portfolio and like move everything into quality. What people should do is just make sure they understand the risk they have on. Okay. Like everybody divested from their bond portfolio over the last 3 years, right? Probably at the worst time. Nobody owned bond. Like we've had a great rally in bonds over the last year. So like people kind of miss that. So, anyways, my point is that I think that people's risk tolerances are different. Some people will say, I don't really care what the market does. I'm in it for the long term. I'm a compounder. Great, good for you. I mean, and they don't want to pay tax. So I think everybody just has to understand the risk they have on. It's a late cycle environment. Equity risk is greater than you think it is, particularly with valuations high and earnings at a peak.
Late cycle is something that clearly Warren Buffett is looking at as well. So
Yes.
That Buffett indicator, which we've talked about a number of times, went north of 200%. I think it's the first time ever. If it's not, it's probably close to the all-time highs in terms of percentage. I think he now has close to $280 billion worth of cash and cash equivalents on the balance sheet. They've been paring down positions in Bank of America and Apple. Maybe that's just a positioning thing, but it's clear that there's something going on there. He is clearly seeing what you're seeing. Now, the optimist will say, Mike, and I'm not trying to get in his head, the optimist will say, well, wait a second. He's basically setting up Berkshire Hathaway for the successor, whoever he or she may be. I think we probably know. My pushback is, I don't think that's what's, it's sort of the Hyman Roth thing. He thinks he's going to live forever. And I think he plays by the rules whether he's 50 years old or 85 years old. He's going to do the same thing because that's what he's done historically. So when you see what somebody like that is doing, you can acknowledge it and say, you know what, it's different this time. Or you can acknowledge it and say, maybe he sees something that I'm seeing that right now the market's not sniffing out.
I mean, he's the greatest value investor of all time. And there's not a lot of value out there, particularly if you're doing any analysis around like what the earnings growth is projected to be versus what it looks like it could be. And by the way, we don't need a hard landing for stocks to correct another 10 to 15%. I mean, let's just look at the numbers, right? So we're 21 times earnings, and those earnings right now are forecast to be 10% growth this year, 15% growth next year. In an economy that's growing below trend, where inflation is actually decelerating below 2% most likely. So somebody needs to explain to me how we're going to get...
How?
Well, we're not.
Yeah.
So the question is, now you're paying 21 times for earnings that probably got to come down by 5% in a soft landing. That doesn't add up. So our call has been consistently 19 times is sort of about as much as I'm willing to pay in this environment, which is about 10% just on multiples in a soft landing. And that assumes no earnings correction. So that's 10% down. That's your 5,000, and then we'll revisit. But remember, that's fair value. That's not cheap. Buffett is a guy who wants to buy stuff cheaply.
Right.
So that would be something more like probably 4,500 or something lower before he starts getting really interested in, taking big swings the way that he typically does.
Okay, agreed. But again, people say, Guy, you don't push back. So I'm going to push back a little. I'll play devil's advocate. The optimist, the bull will say, globally what's going on, you're willing to pay more in terms of valuation for the United States because of all the other junk that's going in China, in Europe, and elsewhere. So U.S. is deserved of the current multiple it's trading at. I don't believe that, but that's part of the bull case. Thoughts on that?
Well, I think, once again, we raised our PE multiple from 17 to 19. 17 times is kind of the more fair value number, quite frankly. 17, but we said, okay, we'll give you that premium, and we agree with that. And by the way, there was something that we maybe underestimated 2 years ago. Maybe we should trade it 19 times. Fine. But 21 times, okay, that is in the top decile of all history. And that doesn't even adjust the earnings, which are at peak. In other words, the cyclically adjusted price earnings multiple is in the fourth or fifth percentile. So it's just expensive. No matter how you slice it, it's expensive. Markets can stay expensive for a long time. I'm not, I don't have a crystal ball. I can't tell you that this is completely unfair, but you're giving a lot of credit here for a lot of things. Earnings above trend, multiples, in the top decile, late cycle with, recession risk elevated, and policy that's behind the curve. So, I mean, there's a lot in your face.
Of all the things you mentioned at the opening that are signaling a slowdown, energy prices being one of them, oil to me is really interesting. With all geopolitical noise that's out there, oil is still hanging just at or below $70, and it's gone down pretty hard in the last, 6 weeks or so. So energy stocks in general, I know they normally fall into whatever early stage, late stage, whatever they might be. It's interesting because the sector's gone through a massive M&A area, right? And from a CapEx perspective, from a balance sheet perspective, they're unlike anything that they've been in quite some time. So I'm wondering, how do you think about energy stocks here? And what is the explanation, other than a slowdown in China and an economic slowdown portending here, that oil is down where it is at these levels on a relative basis from where it was?
So energy is a classic late cycle group that typically does good at the very end. Now, it did in the earlier part of this year. It had a nice February, March, April, and then it literally peaked in April as we went to the defensive.
It's not lining up now is my point, right?
Well, that's the thing. So we've kind of crossed, there's late cycle and then there's late cycle. So we're in the later stages of the late cycle is what that's telling me. We had a call with our commodity analyst today, our energy analyst, and he was going around the world. I mean, demand is the problem all over the world. It's not just China, okay? India demand is down. The U.S. demand is down. European demand, diesel demand is down. And the curve is structured in a way in a way that they're trying to build inventory basically because you can sell product in the future now, lock it in. So that's telling people I want to buy stuff and then sell the forward curve. So that's all a sign that demand is the problem. And I think it's emblematic of a late cycle economy where there's just not no pun intended, not a lot of gas in the tank. We're really going on fumes now in terms of organic demand.
But that doesn't match up. I'm saying the obvious. It does not match up to the market levels you're talking about 21 times. It just doesn't, because that indicates some type of landing, whether it's hard or soft. I'm just saying, and I know you're not an energy expert, But where the stocks are right now, I know you say the late cycle. You're not buyers of the energy stocks here at this point?
No, because if you're really, I mean, if they're telling you, well, I'd rather own energy than other things.
That's what I'm asking.
Yeah, I mean, on a relative basis, that's why we're overweighted, but it's been a bad call because it was cheap. We said, okay, this will hold up better in a decline because it's already been wiped out.
It's just ironic to me that it's going to be deemed quality, which I think it will be if we do go into a true
the large cap one.
Exactly.
So once again, I wouldn't be buying like the E&P. I'd be buying the integrated, the higher quality names because they will hold up better in a fully late cycle economy that has a hard landing. So and eventually that will happen, whether it's this year, next year, or 2026. I mean, this isn't going to go on for 4 more years.
Let's go back to the job market because I think this is more important than the market is pricing in or talking about, my opinion. Some rule gets triggered a month or so ago when we printed 4.3% and the unemployment rate. Claudia Sahm walked it back a little bit. Doesn't necessarily matter. People say it's different this time given the historically still low levels of the unemployment. You've heard it all. Without question, to your point, the job market is softening. I think we can all agree on that. This is one of those things, though, once it starts that sort of escape velocity, it doesn't stop. Fed could cut 50 basis points today, and this is in motion for a period of time. So thoughts on the importance of the unemployment rate and the job market specifically?
It's everything. For the cycle call, it's everything. And to your point, I mean, we've kind of crossed the point of no return on many measures, whether it's the Sahm rule, there's the McKelvey rule, the Joshi rule. There's like a dozen of these things, and they've all sort of been triggered. Now, the explanation for why it's different this time is because of immigration, that the denominator is driving the unemployment rate. But then, of course, we found out a few weeks ago that we lost 800,000 jobs.
Yeah.
And that's another thing that happens in a late cycle economy is these revisions are always on the downside. So last month, we got a 2-month revision of 100 plus, or I think it was 86,000 jobs, which means that the week report in July was actually even weaker. So that's a numerator problem, right? The actual number of jobs being created. And then the third thing I throw into the hopper, which goes back to my original argument, is that most of the job creation is government related.
Yes.
Whether it's government jobs directly or social services, healthcare related jobs, state and local employees. And the private economy is just flat as a pancake. It's not producing, it's not creating new jobs right now. So as far as I can tell, the labor market is already topped. And it's in motion, as you rightly point out. And now we're just waiting for when it inflects.
The other thing that it's worth mentioning, and people say, again, it's a function of this different economy, maybe, but I think we have historic numbers of people working multiple jobs. Now, in my youth, that suggested that people are just trying to make ends meet. Other people say, no, you're missing the boat. That's just the way the labor market is now. People can work. I'm sure it's some combination of the two, but it's never just that simple. It's always one dominates the other. I think it's because people are hurting and they're forced to do it. Thoughts on that, if any?
I'll tell you what's different about this cycle from my perspective, and we get our own opinion about this. The first one is what we already talked about, which is that it's very government heavy. Okay, this is the most government heavy economy I've ever seen. I mean, the percentage of growth being produced by the government is, I think it's 25, 30%. I mean, of growth, it might be 50% currently because the private economy is really not growing at all. So that's different. And the other thing that's different is inflation. Your point earlier, not the rate of change, the price levels, which is forcing people to take on more jobs and kind of make ends meet. They've spent down their savings. They're using credit cards now to kind of, buy everyday necessities. And we have this sort of K economy, okay? People who are geared to the government and have government jobs are fine. People who are more geared to the private economy are probably struggling a bit more. And that's not sustainable. Now, it has been sustainable, and it's probably lasted longer than I would have thought if you'd asked me 2 years ago. But, it's running on thin ice now. So we'll see. We'll see how it goes. But I think the market has it right. I want to go back to this one more time. The market's not ignoring this. Okay, that's what's key here.
No, I'm glad you mentioned that. I'm mentioning through the lens of the S&P 500.
That's right.
But below the surface, there's absolutely damage being done. So I'm glad you're bringing this up, please.
Yeah, and back to Danny's question earlier. I mean, the S&P 500 is the biggest, safest lifeboat in the world, particularly in a world where people are not that cool with government sovereign debt because of the deficits where they are. So there are people saying, I'm just going to own this high quality asset that has proven itself over time. That's the S&P 500. It is a incredible, it is the luxury item of all luxury items, and people take comfort in that. So I can't disparage people for doing that. It's not like it's irrational, right?
You beat me to my next question, which is the debt and the deficit. Since you were last on, we've gone up more than $1 trillion. Remember when you were approaching 36?
Just $1 trillion.
Yeah, just another trillion since you were kind of last on here. And the point you made earlier, the amount of fiscal stimulus has masked a lot of the issues. I go back to Guy's point he made about the savior of Silicon Valley and the BTFP or whatever the thing was. At the same time, they also raised the debt ceiling to an unlimited amount for a period of time. So we're in this kind of period where there's all kinds of liquidity, right, in the market. What happens when the market starts to care about that? And I think it's starting to be reflected in certain asset classes, the dollar obviously being one of them. How do you judge that? Because, I know it's hard to trade the end of the world, but how do you think about that stuff? Because no matter who wins the election, which we're going to get to, because we're not going to have you on until after the election, probably next time, but put that together here and tell me what that looks like. So.
Well, it looks like what we've got, which is that, as long as the machine is rolling, right, assets can still perform. Now, some of your listeners probably are aware of this because you guys talk about it all the time, but gold
that's where I was
has
going with.
outperformed.
I led you.
Has outperformed S&P not only since the over the last 2 years, but over the last 20 years. If you think that's kind of crazy.
Yeah.
Bitcoin,
it doesn't pay a dividend, and it's outperformed.
And Bitcoin has done even better. So with the market, once again, is not dumb. The market is saying, okay, fine. Stocks are an inflationary asset, and if I'm going to be debased or depreciated away or inflated away by government spending, as long as it's not a hard, if they keep it going, yeah, stocks can do fine. I think that's where we are.
But you say that, and what if rates start to move up on a term premium perspective? That's a whole different ballgame.
Oh, totally. But we're not there.
No, we're not there. But if that happens, then the S&P is not a safe place to be. No. And I know you don't have a recommendation on gold. I don't believe that. I don't know what it's included in commodities where you, because it's not a cyclical commodity as much.
No, we're bullish. We've been bullish on gold as a firm. Yeah. So
as a firm, but I'm saying in my
world too. Sure. Yeah. Okay. I don't have a defined allocation to gold, but anybody who's talked to me knows it.
No, I know that. But in miners, in the hard asset,
both. Okay. Silver, gold, also the miners. I'm not going to talk about Bitcoin here. It's also a different asset to me.
Yep.
It's more of a spec asset.
It also hasn't had a test of.
It's a spec asset more than it is it hasn't been proven, to your point, as a true store value currency. I just don't know. Okay. But it has those properties, and I think people are buying it for that purpose.
In less than 2 months, there's going to be a presidential election. I'm not asking you to tell me who do you think, because it doesn't necessarily matter. I think what matters is, regardless of who wins, it feels as if there are going to be inflationary pressures for a myriad of different reasons. Now, I understand that if it's a split government in terms of Congress, I get all that, and that could be best case scenario. But thoughts in terms of the market, the importance of this election, and not the outcome necessarily, but the aftermath.
Sure. Cyclically, in a disinflationary, deflationary camp, because that's where we are in the bigger cycle. This goes back to our sort of 1940s boom bust cycle, and that's still on track. It just got extended. The last boom got extended one more little pop here, and so we'll have a cyclical downturn in inflation. We're in it now. I don't know where it bottoms. And then the next wave of inflation probably won't be as bad as post-COVID because that was a little extreme, but directionally we should make a higher kind of normalized level of inflation. So if inflation is bottoming at a higher level this time, well, then the next top will be somewhere in the range where we were last time, and then we'll bottom at a high. So it's a higher high, lower, or higher low, higher high kind of trend. And, that has to have implications for term premium, has to have implications for real rates and nominal rates and valuations. That's why 21 times in the context of that is even more.
Doesn't make any sense.
It's even more extreme. But until proven guilty, people, I think, object in motion stays in motion.
How important is then the AI trade, the sector, to this entire thing? I think you would submit and I agree with this, it's not going away without question. It is a generational type of technology, or, we're in this sort of period of time where people look back and say, okay, that was we're at the infancy stage, but so much of it, in my opinion, has been pulled forward and priced in. Thoughts on that?
Yeah, well, I mean, look, the AI theme has many facets to it. I mean, first of all, let's talk about what it really is. It's just the next category of compute, right? So it's machine learning, the next phase. It's the next generation of cloud computing. The real productivity benefits, which is what people should be excited about, are years away. We're not going to have real productivity benefits from this spending until there's a solution that's easily delivered to the average company, right? So, and that's going to be done by the cloud, the hyperscalers. They're going to have a full soup to nuts solution that they can deliver, that the enterprise can turn it on, give it to all their employees like email was in the 90s, be like, boom, it's easy. It's simple. We're just not, we're just not there yet. The application layer has to be developed, okay? The costs have to come down. We have to figure out the energy consumption side of this thing, okay? And so this is the first leg of it. And this is its own little boom bust cycle.
We've seen two companies that have seemingly are at the forefront of monetizing that. I would say Facebook did a decent job if you read their last quarter. And to a certain extent, Walmart did a really good job if you read their last quarter. Those two, I don't think anybody's figured it out. And at a certain point, you know, with all that spend, the market's going to demand the return on that investment. And to your point, it's probably sort of years away. So what's that pivot point when the market says, okay, you know, we're going to start to, instead of rewarding you for that, we're going to start to sort of punish you for that?
Just start happening. It happened last quarter. As I mentioned earlier, the hyperscalers got punished for spending too much, overspent, getting gouged almost on pricing for some of the compute that they're paying for, and not showing any return for that. So will that slow them down in the short term? They're all saying no, but I mean, I wouldn't be surprised if there's a little payback as you kind of put out, and that's the way investment cycles go in technology. It's usually all in, digestion, and then back in again for a second wave.
Shifting back economics, can you explain to the common person when you say 2% break evens and what that really means? Because I think, obviously it's numbers that are put together, but what does it tell you right now?
Right. So the break-even market is basically the inflation expectation market as priced by the markets. They trade, and they're thinly traded. People should know that. This is not like the treasury market, which is extremely liquid. It's pretty thin, but it's the best gauge we have of what's the market's expectations about inflation over 1 year, 2 years, 5 years, and 10 years. So the 10-year break-even now is like 210, 215, which, is basically the Fed's target. So
the expectation of the 10-year yield where it is versus where inflation expectations are is 2%.
2.15% is what's priced into inflation expectations. Though 1 and 2 year is fallen, it's fallen even at a faster clip. So people, like the market now knows that we're in a disinflationary part of the cycle. Why? Because demand has really fallen off. Commodities are nowhere, which is a big part of this. The one area I think where inflation is still high is shelter. Shelter inflation is still quite high, whether it's rent or home prices or apartment prices. So that's the one area, and that's one area where the Fed is watching. But if you actually look at the overall picture, it's hard not to argue that inflation rate of change is at their target. I have a real problem with that philosophy, though. Okay, just as a consumer, I'm like, well, great. So inflation is back to 2%. Congratulations. The problem is most of the things I buy are up 50%.
Right.
So how are we going to resolve that dilemma with that my income is not at 50%, or that my cost of living perhaps is even more than 50% because of where I live? So there's this real disconnect, I think, between the academic world and the real world.
And the goods and services component of what you just mentioned. So you'll buy less goods, right? You'll spend more on credit cards.
That's right.
To your point, those things are happening that later stage. So talk about the service component within the economy versus the goods, because it continues to have, yes, it's slowing at the margin, things there, because that is really what's been driving.
Yeah, because there's latent demand there, right? In other words, during the COVID lockdowns, there was no demand for services, so there was pent-up demand. And then, obviously the services only have a certain amount of capacity. So people have overpaid for that. But even in that context, Danny, if you think about restaurants and airlines and hotels, these stocks are not doing particularly well, and their businesses aren't, they've slowed. Now, airlines are trying to make it up with pricing. That, sometimes it's hard to do when you're a late cycle. So I think even there, even in services, the demand has now...
It's lapping.
It's normalized.
It's lapping.
Yeah, it's not collapsing, but it's normalized. It was extreme, much like goods were coming out of the pandemic, or during the lockdowns, and we had crazy goods pricing. Well, now they're basically in a depression. They have deflation in many goods because people overconsumed it.
Real quick. It's interesting. I agree with you on this as well, and it goes back to what I said about the approval rating of this administration, because people know. I mean, you could say that we're winning the battle on inflation all you want, and through the lens of academia, maybe that is in fact the case. But the cumulative effect has been absolutely crushing people. And you mentioned again owner's equivalent rent and those types of things. Throw insurance on top of that, and if you're living in the United States right now, you are hurting, which is why recession, no recession, you deem it anything you want. For a lot of people out there, and I would submit anywhere from 15 to 18%, I mean, it's worse than recession. You have people living paycheck to paycheck and trying to make decisions on, am I going to heat my house or am I going to feed my kids, those types of things. So there are structural problems without question, again, that seemingly the market's just sort of whistling past.
Well, once again, I mean, I don't think the market is whistling past. I mean, bonds have got a pretty good bid, and commodities have collapsed, and precious metals are trading well because of the policies that are in place, and quality stocks have done well, and low quality stocks have been hammered. So I think the market's done a really efficient job, quite frankly. And we just, just have to get away from this, focus on the S&P 500 or these, even like the DAX, which is even more concentrated than the S&P 500. You just have this concentrated kind of asset pool. So different than like real estate, right? High-end real estate continues to, that's always protected to some degree, location. There are parts of the real estate market now that are coming under pressure because there's a lot of supply and there's a lot of construction that's being finished.
So $64,000 question. All the indications, the break-evens, where the yield curve is, they're telling you that the Fed's behind the curve, right? So the market's pricing in already that the Fed's going to be aggressive, more aggressive than they're actually signaling. What does a 25, 50, or 75 cut in rates really do anyway? And I say this under this kind of tongue-in-cheek. This market has all been about immediate gratification. What did it do for me now? How do the orders mean to the AI stocks now? So when you do get the cut, and I think it potentially, if it's 25, it's a dovish cut, if you want to call it that. They'll give an outlook that they're here for you. Don't worry about it. What the hangover effect of that?
That's right.
What happens?
Well, first of all, basically asset prices make highs on good news. Okay, people always forget this. I have to remind myself too. They make lows on bad news. So if you think about the AI names we just kind of talked about, they all topped on really good news in the last quarter. I mean, there's nothing wrong with the quarters that were reported, but they all topped and they're all down between 10 and 30%. Some are down 50%. Okay, so next week I'm pretty excited for next week because we've been waiting for this moment now. It seems like for 18 months. They've been throwing out the, hey, we're going to start maybe pivoting and maybe start cutting, really for about 11 months, okay? And the anticipation of something is often more exciting than when you actually get it. So it's easier to travel than arrive. So I think next week what's going to be critical is I'm pretty sure they're going to do 25 at this point. They haven't prepared to mark for 50. And with today's CPI number, which is a little hotter on the core side, they can't do 50. And plus it sends probably a signal they don't want to send. So they do 25. That's not what's exciting. What's going to be exciting is how does the market trade on that cut? I don't know, but it's going to determine the way people interpret the cut.
And you have Bank of Japan 36 hours later,
Correct.
By the way. Think people are going to be, Fed. And then what do you mean Japan? What happened on Thursday night, which is Friday morning? But
right.
Anyway, yeah.
Well, we started with that. And I think, we're not going to end with that. But I'm going to say, again, maybe the market is paying attention to it in terms of the things that you mentioned. I get laser focused in the S&P to my detriment. But there are other, obviously, asset classes that have sniffed this stuff out. But what's going on in Japan, specifically with the yen, we here in the United States have a yen problem. There are 11 sectors, 5 overweight for Morgan Stanley, 5 neutral, 1 underweight. The one that I really want to sort of get your comments on, overweight industrials in what I think we all agree is sort of late cycle. I think part of industrials probably encompasses aerospace defense names, ex-Boeing, that have done extraordinarily well. When does that start to scare you in terms of that overweight? Are we close? Are we still? Thoughts on that?
We've been very clear that in the energy and industrial overweights that we want large cap quality within those buckets only. So not going into the really cyclical stuff within those groups. I'm getting nervous now because we've gotten more defensive. Some of the industrial data points have kind of fallen off a bit more recently. The ISM orders were 44.5, which is, pretty weak. So, yeah, I'm getting a little more nervous. China isn't rebounding. So it's on a short leash, let's put it that way. The industrial energy is there to protect us against being overly defensive in our overweights. So that's really the story. And the main message we've been giving clients pretty consistently for really since April and really May is that we're going further down the late cycle curve. It's going to get more defensive. That's worked. It's now crowded. Those stocks are expensive too. They're starting to act a little poorly now. So I'm getting nervous about a correlated move. And that's why I think next week is really important. Follow the BOJ and the Fed collectively. Like, this is where the action is. It's like the policy moves and the reaction to those policy moves can really cause markets to get correlated like they did in late July, early August.
That's sort of the be careful what you wish for portion of this market. So we'll see how it plays out. You are a Chicago Bear fan. Good for you. Week 1, you emerged victorious. It was an ugly win, but in the NFL, you don't get style points, Danny Moses.
You do not. And so
we have reached week 2 in the league where they play for pay. First of all, before we start, you picked 3 games last week.
I did.
I think you were 1-2. If I had to guess off the top of my
Thursday
head.
game, you can go count it, even though people didn't get it. 1-1 over the weekend. But yes, 1-2. I'm happy to eat it. Should have won all 3. We won't talk about the in and out.
I mean, you're embarrassing
the likely foot on the line and thing, but it's fine. I can live with it. It's football, baby.
So we have reached week 2.
I have 5 games this week.
Well, that's what. So you have 5 games for us to dissect.
I do. And I'll save the best one for last.
Well, please.
For Mike Wilson over there. All right. So I got basically 3 favorites and 2 underdogs.
Okay.
And I love home underdogs.
Home dogs.
And I love home dogs for the opening game of the season for the home openers for these teams, right? So Tennessee, sorry, Vinny, getting 3.5 against the Jets. Jets fly west, Jets fly east, Jets fly to Tennessee. Tennessee's not a bad football team. Obviously, there was some bad plays by the quarterback there towards the end of the game. I like Tennessee getting 3.5 at home. The Packers, I know, Guy Adami might be playing quarterback. Willis is playing quarterback for the Packers. You know what? They'll keep that game close. 3.5 at home against the Colts. I don't think the Colts are that good.
Fair enough.
3.5, I think they keep it close and cover those. So they're the 2 underdogs. My 3 favorites are the following. Eagles are going to dismantle the Falcons. Now, people forget, yes, Eagles flew to Brazil to play that game against Baltimore, but they got 2 extra days of rest. They're coming home. I like Eagles minus 6.5. I love the Ravens, and I'm ashamed I didn't bet it earlier. Ravens against the Raiders, right? Raiders flying east. Again, they played a late game. Now they're coming east. Baltimore had the extra day off. Line's 9.5 now. So the way you trend following on the algos and stocks, you should be pounding the Ravens at home. They're pissed about what happened against Kansas City. Again, 3 extra days of rest on there. The best for last, Mike, is that Houston now going home after should have won by more than 2 points, but they didn't, going home against the Bears. And now the Bears found a way to win that game. That's great. Give me Houston. I think the line is 6. So those are my 5 picks. I never really normally give out 5, but I feel like early in the season.
You're feeling good about yourself.
I'm feeling okay about
feeling
myself.
Your oats.
So
well,
maybe
hoping,
a 4-1 week. Maybe a 4-1 week.
You're hoping to go 4-1.
Yeah, that's it. So
logic suggests you'll go 3-2, which will make you 500 going into week 3.
Mike, you guys both have bad quarterbacks. Not bad quarterbacks, sorry. You have a proven bad quarterback. You have an untested quarterback,
well,
Mike,
people
obviously.
Don't see, when you say, you're looking at me when you say
people know our history, Guy, about you arguing about Daniel Jones. But
can I say something?
Yeah,
please,
of course.
we want you to open.
So you're picking the Packers, and you're with a second string quarterback. Really, they found him on the off
I know what it is.
And you're picking against my Bears. You're dead to me.
You're dead to me.
So forget about that. Forget about that home and
How about we settle this? How about we settle this? I'll take the parlay of those 2. I have to hit both.
Okay.
Right.
Which spread?
Your 2 dinners to my 1 dinner. I have to hit both to win. Okay. Fair.
Fair.
You're getting 6 for the Bears, right?
I'm giving 3.5.
And you're giving 3.5 for the other one. All right. Fair enough.
Mike Wilson, you're a must-watch when you go on television, a must-read when you publish, and we are fortunate to have you each quarter. Today is September 11th. This podcast is dropping on Thursday the 12th. As you're listening, we're doing it a day early. Given basically the stature of you, we think we should drop it a day early. And hopefully, if we're fortunate, we'll have you back in December of this year to close things out. So thanks for joining us, Mike.
Thanks, guys. Great to be here always.
Thanks, Mike.